So housing stats came out this week for October, and let me give you some insight into what I think it means. CoreLogic, solid outfit, came out with their year-over-year increase as of October was 7.3%. That means home prices went up 7.3% from the previous October, which is huge. Couple things about that. One, you have to remember that home sales that take place in October were negotiated in September or more likely August. Okay, transactions negotiated in July and August because a lot of parts of the country it takes you 2 months to close, especially during COVID. So call it summertime 2020 negotiations. People that were house hunting in the middle of COVID, right, from the second quarter, third quarter, that were just getting out of wherever they were going and making a rapid move, right? So those October numbers were absolutely the summer market and the spring market all packed into one period of time in the summer of 2020. Naturally, home prices will come up. So what's going to happen next year? Anybody's guess, but here's mine. CoreLogic forecasts 1.9% increase next year. So that basically shows you that it got artificially inflated by a really specific circumstance driving demand, and then it's going to flatten out so as not to become a bubble, right? It's going to flatten out. And it's funny that the average of those 2 years is right about the national average. Here's a chart I love. This is a 20-year average price nationwide, all right? You can see the housing boom. You can see the housing bust, such as it was, and you can see the recovery, and actually puts it all in context, makes it all seem much less dramatic what happened 10 years ago. But that 20-year average is 3.63%. Now, why is that valuable? Number one, Democrats, Republicans, wartime, peacetime, high rates, low rates, recessions, economic booms, housing boom, housing bust, everything is on that chart. Okay, so volatility is already baked into that index. I find this to be really a comforting number and a reliable number of what's going to happen over the next 20 years, because this chart, you just can't mistake the fact that a trend line's established in the first third. It deviates in the second third, but look where the trend line picks back up again, right in the middle of the peak and the trough of the boom and the bust. So the trend line cuts right across the middle and then it catches back up again. So this gives me a lot of faith in the equilibrium. It also shows you the benefit of seasonality, right? Buy in the winter because the prices are the highest in the summer. So anyway, back to here, that puts us that over the 2-year period of 2020 and 2021, 7.3 divided by 2 is 3.65, right at the average. So this is literally double the average. And then it comes down to only, less than 2%, which means that it's going to be something that if this happens, it will be something that we digested whatever COVID bubble was created, which I think is great. If this were to come to pass, what it actually looks like. What it looks like is today we have historically tight inventory. There's no houses on the market, right? I've never seen anything in 30 years so tight. But for this to take place, what has to happen is the sellers who are feeling their oats right now, they're pretty excited. They're seeing this big increase. They're going to come out on the market with inflated prices in 2021. And either that's going to carry and the demand is going to continue to drive prices up, which means this is not going to come through here. And we have a little more inflated prices to have to deal with in the future. Or the buyers are going to say, no way. Okay, for this to take place on this chart right here, that's what has to happen is the buyers say, no, thanks. I'm not going to pay your extra inflated price. It's up 7.5% this year. I'm not paying another 10% in the spring of 2021. For that to happen, the buyers say no. What happens? Inventory accumulates, the days on market stretch out, and the market normalizes. And I think this actually has potential. Let me show you why. This is an analysis that I put together back in April when we were trying to figure out the nature of the recession that we were headed for by looking at the way other recessions in the past behave and how this one might also behave. So the first thing that always happens is something, and then human beings freak out and sell all their stocks, right? So COVID, 10 years before, housing crisis, 10 years before that, tech stock bubble, right? There's always some economic event. And the human response is dump the stocks. The next economic event is the sharp decline in the stock market. Then you've got consumer confidence suffering as a result. And the response there is don't spend any money. Then you've got business confidence beginning to notice that, right? At some point, people aren't in the stores. People aren't on the website. So they start pulling back on employment. Unemployment goes up. Home sales eventually decline. Home prices eventually decline. This pattern is what always seems to happen. The thing is, it usually takes a year or two for each of these different stimuli to create the next economic event, and the snowball, the chain reaction continues. Funny thing is, in 2020, it all happened in 8 weeks. So the big question was, in this hyper intense recession, what is the recovery going to look like and when's it going to come? And the theory is that these things, a recession and a recovery, are two chapters of the same story. I wrote this book, Crash Boom. They're connected, right? This was a study of the Great Depression, recessions after that, as a way to try to figure out what was going to happen in the middle of the Great Recession. So same idea. Now that we were in the middle of the Great COVID recession, what was the recovery going to look like? And the key learning from the research for that book was these things are connected. Chapter 1 and chapter 2 of the same story, right? So when you have an intense and fast recession, would you maybe have an intense and fast recovery? Well, stock market came right back. Consumer confidence came back almost immediately. Not the sectors that were the hardest hit, but everybody else, right? Home sales and home prices didn't even get affected. It happened so fast. All right, so going back over to here again, normally if we have an intense seller's market, the pendulum swings up here and you are seeing buyers clamoring over each other to buy properties. That's not going to turn around between December and the following spring market. But all bets are off with COVID, right? So there's part of me that says, if this thing continues to follow the same pattern, we are going to see a shift where the buyers are going to get more stubborn, but they're going to do it a year earlier than they otherwise would have. That would be first quarter 2020. So we'll see, but if it does come to pass this way, these will be the reasons why it did. Thanks for watching.